Hello and welcome students. In the last video lecture, I had explained you question number 9 of chapter number 2, that is final accounts of partnership firm, that are very important. Now I will be explaining you today in this video lecture, that is question number 11, that is on page number 80 of your textbook. So let us read the question first of all, and then afterwards we'll do the practical solution of it. From the trial balance and adjustments of partnership firm of Salim and Shabana, there are two partners, that is Salim and Shabana. Prepare final accounts of partnership firm. From the trial balance and the adjustments that are given to you, you have to prepare the final accounts of partnership firm. There are capital account of two partners, and afterwards current account. Now over here the current account balance is given of both the partners. It means whatever the transactions related to the partners will be given in the current account and not in the capital account, because it is as per fixed capital method. So as per fixed capital method, the capital would remain, the opening balance and closing balance would remain as it is. It means you can see the opening capital, that is of Salim and Shabana, that is given to you 1,60,000 and 1,20,000. So you can see in the balance sheet at the end of the year on 31st March, the capital is shown as it is, that is of Salim and Shabana 1,60,000 and 1,20,000. It means opening and closing balance of capital would remain as it is when the current account balances are given to you. So you have to prepare partners current account, not partners capital account. So whatever the transaction related to partners, you will give it partners current account. Okay. So starting with the posting, so, first of all, capital account balance is given to you, that is of Salim and Shabana, that is directly I have posted over here. You can see on the capital liability side of balance sheet, capital of Salim and Shabana 1,60,000 and 1,20,000. Total that came to 2,80,000. Then afterwards current account, that is given of Shabana and Salim. Current account, that is of Salim, that is credit balance, and of Shabana, that is debit balance. So you can see on the credit side of partners current account, by balance brought down, that is of Salim, I have written 40,000, and 2 balance brought down because debit balance is given of Shabana. So 2 balance brought down, that is of Shabana 10,000, opening balance of current account. Okay. Now students, one thing make it sure, over here I have prepared revised trading account, P&L account, partners current account and balance sheet. But I have not prepared the P&L appropriation account, because any of the transactions such as interest on capital, salary, bonus, commission, interest on drawings, such transactions are not there in the entire sum. So there is no need to prepare P&L appropriation account. So while preparing the accounts, first of all read the question according to the requirement of the question. You have to prepare the concerned accounts. Okay. So here I have prepared revised trading account. The word revised, why it has been utilized, because you can see in the question the trading account balance has been given to you in the trial balance. It means already the trading account gross profit is given to you, but even after getting the gross profit of trading account, there are few entries that are left to be posted in trading account. That's why again the trading account is being prepared over it. That's why the word revised trading account is being given over here. Okay. So basically we have to prepare in this sum, that is revised trading account, P&L account, partners current account instead of partners capital account, and balance sheet as on 31st March 2017. Okay. Now current account posting, capital account posting, that we are done. Moving on, stock of goods, that is 31st March, it means closing stock is given to you. And whenever the closing stock is given to you in trial balance, only one effect would be there, that is on the asset side of balance sheet. So you can see on the asset side closing stock that I have written, that is 54,600. Okay. Then afterwards, after closing stock, that is cash balance, that is 560, that is also having a debit balance. Asset side you can see I have written cash, that is rupees 560. Then afterwards current account with bank, that also on the asset side of balance sheet, that is 14,000. You can see current account with bank, I have written short form CUR. Current account with bank, that is rupees 14,000. Then afterwards fixed deposit of SBI, that is also one kind of investment for the firm. Students, I have not given separate headings over here, that is fixed assets, investment, current assets and so on. I have just written it without giving any kind of headings over here. Okay. So directly I have written FD of SBI, that is rupees 80,000. If you wish, you can give separate heading, that is first part of fixed assets, second one that is for investment, and then afterwards the current assets. Then afterwards, debtors and creditors, that is given to you 36,800 and 24,000. Students, while you are referring the question, see that you refer the adjustments also together, so that any of the entries which are related to the adjustment in the trial balance, so that you can write that entry in the concerned account in the inner column, so that you need to leave the space for giving the effect of the adjustment. So accordingly, you will leave the space and you will write the account, so that no any errors or mistake or overwriting of the entries would not be there. Okay, so now afterwards, understand debtors and creditors, that is 36,800 and 24,000. You can see debtors I have written 36,800 inner column, because adjustment of bad debts and bad debt reserve is given in the question. Okay, and creditors also in inner column, that is 24,000, because there is also an adjustment given. Now salary, that is given to you 37,000, that would be on the expense, so debit side of P&L account. To salary, that is in outer column, that I have written 37,000, because no any adjustment is there on salary. Then afterwards, land and building, that is an asset, that is 1,20,000 given to you on the asset side. First entry that I have written, no any adjustment is there or depreciation is there on land and building, so as it is in outer column, land and building 1,20,000. Then afterwards, machinery, that is office purpose, that is 40,000. So machinery also, that I have written plant and machinery over here, that is 40,000. Then afterwards, furniture, that is given to you 10,000. So furniture, that is also in inner column, because depreciation is provided in the adjustment for machinery and for furniture. Okay. Then afterwards, insurance premium, that is 2,000. It is an expense, so it will be recorded on the debit side of P&L account. You can see I have written in inner column to insurance premium 2,000, because there is an adjustment of prepaid insurance premium in the adjustment in the question. Then afterwards, leasehold machinery, that is given to you 60,000. Now you can see, because of lack of space, I have written down machinery. Actually, you should write in the heading related to the fixed assets. Over here, I have written machinery, that is 60,000. Leasehold machinery, that is value given to you 60,000. Now there is a hidden adjustment. Over here, you can see the date has been given to you in the bracket, that is 1st April, from 1st April 2016 for 5 years. What is our accounting year? That is 1st April 2016 to 31st March 2017. Okay, so this 60,000 is for 5 years. We have to provide only for the current year. So 60,000 divided by 5, then you will get 12,000. Okay, so 60,000 divided by 5, 12,000. So you will write off how much amount of machinery, that is rupees 12,000. So here you can see 60,000 minus 12,000. Outer column, that I have written 48,000. And the same amount, whatever I have write off for machinery, that second effect, that would be on the debit side of P&L account. You can see on the debit side of P&L account, that I have written to write off on machinery, that is rupees 12,000. Okay. Now after completing of machinery, that next one, that is stationery and printing, that is rupees 1,200. That is debit side of P&L account to stationery and printing, as it is in outer column, that is rupees 1,200. Then afterwards, bad debts and bad debt reserve, that is 400 and 2,000. Bad debts will always have a debit balance, and bad debt reserve will always have a credit balance. Now students, already we discussed the format of bad debts on the debit side of P&L account. Again revising, that is 2 bad debts of trial balance. TB means trial balance, A means adjustment. 2 bad debts of trial balance plus bad debts of adjustment plus bad debt reserve of adjustment. From the total of these 3 values, we have to subtract the value of bad debt reserve of trial balance. Okay. Now over here, you have been given the balances of trial balance of bad debts and bad debt reserve. Okay. So bad debts value, that is given to you 400 as per trial balance, and bad debt reserve as per trial balance is given to you 2,000. So concerned places, I have placed the value of bad debts and bad debt reserve. Then afterwards, advertisement expense, that is given to you 1,200. So as it is, advertisement expense will be written on the debit side of P&L account to advertisement expense, that is 1,200. Then afterwards, traveling expense, that is given to you 800. That also, as it is on the debit side of P&L account to traveling expense, that is rupees 800. Then afterwards, trading account, that is given to you 61,800. That is the old gross profit. Still one or two adjustments related to trading account are remained. That's why we are preparing the revised trading accounts. You can see whatever the balance that has been given to you of trading account in the trial balance, that I have written on the credit side. Also you can see the credit balance is only given to you of trading account. So I am writing on the credit side of trading account. Buy balance brought down, that is 61,800. Then afterwards, loan of Shabana, that is 60,000. So that would be our liability, because in future we have to pay this loan to the concerned partner. So loan of Shabana, that is rupees 60,000. You can directly show it also in the outer column. I have shown it in the inner column because interest would be there, because date is provided to you in the bracket. Students, if the date is provided to you in the bracket, it means you have to calculate the outstanding interest on loan. You are already knowing that 6% interest on partner's loan is to be provided. If no any interest rate is given to you in the question, it means it is understood that 6% rate of interest is to be provided on partner's loan from the date when it has been borrowed, or from the date when the loan has been provided by the concerned partner. Over here you can see the date has been given from 1st October 2016. It means October, November, December, January, February and March. 6 months interest at 6% rate of interest that you have to count on the loan of rupees 60,000. So for 60,000 at 6% for the entire year, it would come 3,600. Half of 3,600, that would come to 1,800. So you can see I have added over here plus outstanding interest on loan, that is 1,800. Total that I have written 61,800. These are called hidden adjustments. Whenever the date are given in bracket, it means it is understood that they are hidden adjustments. Okay. So we have to give the effect of this hidden adjustments. Also two effect would come. One effect, see I have written over here, that is liability side of balance sheet added in the concerned loan. You can write both the amounts separately in the outer column also, 60,000 and 1,800. I have done the total in the inner column and written the I have done the total over here and written the total in the outer column. Okay. Now the second effect of this outstanding interest on loan, that will be on the debit side of P&L account. You can see last entry that I have written over here, to outstanding interest on loan, that is rupees 1,800. Okay. Now after completion of the loan, last entry of the trial balance, that is discount reserve, that is given to you credit balance. Now discount reserve value that has been given to you 760. Now see students, in the fifth adjustment concerned to discount reserve on debtors is not required. Now students, make it clear, whenever discount reserve or any kind of bad debts or reserve has been given to you in the trial balance, and in the adjustment it has been provided to you that now that bad debt reserve or discount reserve is not required, then only one effect of that discount reserve or bad debt reserve would come, that is on the credit side of P&L account, that is by discount reserve on debtors. Again repeating, whenever discount reserve on debtors is or bad debt reserve on debtors that is given to you in the trial balance, and also in adjustment it is given to you that now discount reserve or bad debt reserve is not required or not to be maintained, then only one effect would come of that discount reserve or bad debt reserve, that is on the credit side of P&L account. But suppose the bad debt reserve and discount reserve is given in the trial balance, the value is given and no any adjustment related to it is given in the question. Related to bad debt reserve or discount reserve in the adjustment, then that would be subtracted from the debtors on the asset side of balance sheet. Even though it is old, that is given of the trial balance, generally from the debtors we are subtracting the value of bad debts and bad debt reserve which is provided in the adjustment, not of the trial balance. But if the value of bad debt reserve and discount reserve is given only in trial balance and there is no any adjustment related to bad debt reserve or discount reserve, then whatever the value that is given of bad debt reserve and discount reserve in the trial balance, that will be subtracted from the debtors on the asset side of balance sheet. So over here, this point is very important. Over here, discount reserve debtors, that will be only one effect, that is on the credit side of P&L account, that is rupees 760. Okay. Then afterwards, let us look at the adjustments. First one, that is Salim withdraw goods of rupees 4,000 for personal use. It is not recorded in the books. One of the partner has withdrawn goods for personal use, so it becomes drawings for that particular partner. Always adjustments will be having two effect. One effect that would be on the trading account credit side, debit side. First of all, I have written over here unrecorded purchase. The reason, because goods withdrawn, that would be subtracted, but over here the value of purchase is not given to you. So from either you can write on the credit side of trading account, or you can subtract from the purchase. But for purchase, the second adjustment is also related to trading account. Goods of rupees 8,000 purchased at the end of the accounting year, which is not recorded, means unrecorded credit purchase. Value is how much? 8,000. So first of all, I have written unrecorded credit purchase, that would be recorded on debit side of trading account, and goods withdrawn for personal use, that is to be subtracted from the value of purchase. So first of all, I have written two unrecorded purchase, that is 8,000, minus goods withdrawn for personal use, that is rupees 4,000, that I have subtracted from it. The balance value, that is 4,000, that I have written in the outer column. Now both this effect, second effect is remaining. Here the first effect already were done. Now unrecorded purchase is always having direct relation with the creditors, and sales will always have a direct relation with debtors. Okay, so here credit purchase is there, so one effect that is on the debit side of trading account. Second effect you have to add in the creditors. Okay, so plus unrecorded purchase, that is rupees 8,000, outer column will show 32,000. This is for the second adjustment. Now first adjustment, that is goods withdrawn for personal use. Over here you have subtracted, it means credit effect you have given. Already we discussed that dual effect would be given, and that both the effects, one should be debit and another should be credit. Okay, in this second adjustment, see unrecorded purchase, it means I have written on the debit side, so one effect is debit, and the second effect, that is liability side, I have added over here, so it is credit effect. So both the effect debit and credit are done. Now in case of goods withdrawn, I have subtracted over here on the debit side, it means credit effect that I have given. Now credit effect I have given, so next effect that I have to give, debit effect. Now goods withdrawn for personal use. Now that is drawings of the concerned partner. So as we are showing the opening balance of capital or current account on the credit side, same way drawings will be showing on the debit side of the current account of the concerned partner. So you can see on the debit side of partner's current account, I have written two drawings, that is in the column of Salim, that is rupees 4,000. If you are a partner's capital account, we are making that same way. On the partner's capital account debit side will be writing, that is two drawings. Okay, so two effect of drawings, that is goods withdrawn. Over here goods are withdrawn, cash can also be withdrawn in the form of drawings. Okay, so minus goods withdrawn, that is rupees 4,000, and the second effect, that is two drawings on the debit side of partner's current account, that is rupees 4,000 in the column of Salim, because Salim has withdrawn that goods. Okay, now both the effects, first two adjustments are cleared. Third adjustment, that is prepaid insurance rupees 400. Prepaid insurance means insurance premium has been paid in advance. Okay, so one effect, that is of the current year, it is not of the current year, that is of the next year, that we have prepaid in advance. So from the current year P&L account we have to subtract it. So here you can see minus prepaid insurance, that is 400, 2,000 minus 400, remaining balance, that is 1,600. And the second effect, next year premium that we have paid in advance. So next year we don't have to pay that much amount of insurance premium, so it becomes our asset. So you can see last entry I have written over here, prepaid insurance, short form PP, prepaid insurance premium, that is rupees 400. Okay, then afterwards fourth adjustment, from debtors rupees 800 is not recoverable, provide 5% BDR on debtors. Not recoverable means it's bad debts. Okay, so these are new, that is of adjustments. So that effect will be giving on the two effect will be there. One will be subtracting from the debtors, and the second effect in the table of the bad debts on the debit side of P&L account. So debtors 36,800, that is given to in the trial balance. From that bad debts I will subtract, that is 800. Remaining balance, that is 36,000. 36,000 you will count 5% PDR. Always first of all bad debts will be provided. Remaining balance whatever is there, on that only will calculate the BDR. Okay, so over here 36,000 minus 5% BDR on 36,000, it would come to 1,800. Remaining balance, that is 34,200. Now both these effect of adjustment, bad debts and bad debt reserve, that will be providing in the debit side of P&L account. So you can see on the debit side of P&L account, that is bad debts of adjustment that we have found out, that is 800, and bad debt reserve of adjustment, that is rupees 1800. Now we'll be doing the total of all these three values. So 400 plus 800, that would come 1200. 1200 plus 1800, that would come to 3000. 3000 minus bad debt reserve of trial balance, that was given to you 2000. So 3000 minus 2000, in outer column you will write 1000. Okay, so this format you don't have to forget. Then afterwards, fourth adjustment is complete. Now fifth one, discount reserve on debtors is not required. Already we discussed this adjustment, that is whenever this type of transaction is there and in the adjustment it is given to you that now discount reserve or bad debt reserve is not required to be maintained, at that time there would be only one effect of discount reserve or bad debt reserve, that is on the credit side of P&L account. So here you can see on the credit side of P&L account that I have written by DR, discount reserve on debtors, that is rupees 760. Then afterwards, sixth adjustment, that is provide depreciation on machinery at 20% and on furniture at 5%. So depreciation that we have to count on machinery, that is 40,000, 20%, so 4 to the 8, so 8,000 depreciation that will come. So 40,000 minus 8,000, outer column you will show 32,000. In the same way for furniture. Furniture value, that is 10,000, 5% depreciation on furniture, so on 10,000, 5% it would come to 500. So outer column you will write 9,500. Now the second entry of this two depreciation, that will be an expense, so debit side of P&L account. So you can see on the debit side of P&L account I have written two depreciation heading, machinery depreciation that came to 8,000 and furniture depreciation that came to 500. So total of this two, that is 8,500 in the outer column. Okay. Now all the adjustments that we have cleared, even the hidden adjustment that was of leasehold machinery that we have completed, and even of loan of Shabana also we have cleared, that is outstanding interest on loan for 6 months. So no any adjustment or hidden adjustments are remaining to be posted in the concerned account. Now we'll close one by one all the accounts. First of all, we'll clear the revised trading account. Revised trading account credit side total, that would come to 61,800. Both the side I'll be putting the total, that is 61,800. Difference on the debit side, so it is gross profit, that would be transferred to P&L account. So to revised gross profit, that came to 57,800. Okay, so that is the value that we have found out, that is 57,800. That I'll be putting on the credit side of P&L account. By gross profit, that is 57,800. Now over here, loss is coming, that is divisible loss. Okay, so debit side total is coming more. The total of debit side you will be doing, then you will be getting total, that is 65,100. Both the side I have put, that is 65,100. Difference that came to 6,540. Now that is divisible loss. Generally it would become net profit. But over here P&L appropriation account we are not making, because any of the entries related to P&L appropriation is not given in the question. So over here, whatever the profit that came, whatever the difference that came, I have written the word divisible loss, not net profit or net loss. Okay, so because P&L appropriation we are not preparing. If we are preparing P&L appropriation, then there whatever the difference comes in P&L appropriation, that would be your divisible profit or loss. But over here we are not preparing P&L appropriation, so whatever the difference comes of P&L account, that will be distributed amongst the partners in their profit sharing ratio. Over here there is no any profit sharing ratio given to you in the question, so it is we are calculating as equal ratio, 1:1. Okay, so Salim and Shabana, the total, that is 6,540 is divided into 1:1 ratio, that came to 3,270, 3,270. Okay, now that divisible loss, that will be transferred to partners current account. So credit side of the P&L account, then debit side of partners current account. You can see on the debit side of partners current account that I have written to P&L account, in bracket I have written loss, that is divisible loss, 3,270 and 3,270. Okay, now we'll close the partners current account. In partners current account, in Salim's column, credit side balance is more, so 40,000 both side I have put. Difference that came on debit side, it means in case of Salim, that is credit balance of current account. If the total of credit side is more, it means credit balance, and if the total of debit side is more, then debit balance. Okay, over here in case of Salim, credit side total is more. Difference that came, closing balance of Salim's current account, that is 32,730. Now in case of Shabana, total of debit side is more, that is 13,270. As on the credit side there is no any entry. Okay, so difference that comes on credit side. So it is coming over here by balance carried down, that is 13,270 in case of Shabana. That is debit balance, because total of debit side is more in case of Shabana. So whatever the debit balance, closing balance comes of the partner, that would be shown on the asset side. You can see I have written over here that is current account of Shabana, that is the debit balance of Shabana on the asset side, that is 13,270. And in case of Salim, that came credit balance. So on the liability side that I have shown, that is current account of Salim, that is 32,730. You have to be sure that which type of balance comes of the current account. If by mistake the credit balance that you have written in debit side or debit balance that you have written on credit side, then your balance sheet will not get tallied. So make it sure and confirm which balance is there, and accordingly you put in the liability or the asset side. Now after posting the closing balance of current account of both the partners, we have to close the balance sheet. You can see all the entries already we have completed. None of the entries should not remain in the inner column without doing the total or subtraction in the outer column. All the entries we have completed. Now doing the total of both the sides, you can see the total is coming equal, that is 4,06,530, and over here on asset side also 4,06,530. It means both the side total is coming equal. It means our answer is correct. So that's the end of the sum, students. In the next video lecture we'll be continuing with more sums related to this type. Till then, goodbye, keep practicing, stay blessed.